Welcome back to Dividend Investing. Hey look, 2023 will need a lot of cash and we have got you covered. Today we're going to go over several business development companies or BDCs. These are an investment type on the stock market that can generate you quite a bit of cash flow with strong dividend yields, but also the potential for capital appreciation over the long term. Now, like anything, there's some good picks and there's some bad picks. We're going to go over 3 today, landing on our final and best favourite pick for 2023 that's going to give you high yield and growth. So stay tuned and hit subscribe to learn how to grow your wealth now and going forward. Now my friends, smash the subscribe button and learn how to grow your dividend income with me this year. Let's get into it. First off, Ares Capital, ARCC on the stock exchange. Look, this is the biggest and perhaps the best known business development company, and it's got a lot going for it. It's got a very large lending portfolio with 68% senior secured loans, so relatively strong, relatively safe. Massive diversification here with 458 portfolio companies. Diversification over 23 different industries, and quite a good spread there indeed. So if something goes wrong economically, if the macroeconomic cycles change, it's not going to affect this company and their portfolio too much. Now, one of the things I really love to see is this portfolio by asset class here. Now, they've got a large amount here of 45% of the loans, 45% of the assets are in the first lien senior secured loans. So they're getting this money back basically no matter what. Now, if we scroll through here as well, we see not just the loans, but we also see a small amount of preferred equity as well, giving them a little bit of growth opportunity in the mix also. How well are they doing? If we look at this realized loss rate, we'll see that ARCC basically is not having bad loans out there. So basically the money they lend out is money they get back. Now as an investor in the company, that's something that you should be very interested in. Now this is a really nice little chart here, and it compares them to the banks, which lose a little bit of money there on the loss rate of just under 1%. And other BDCs as well, which often have up to a 1% or more than 1% loss rate. So ARCC, they take care when they make the loans, they do their due diligence, and they make safe loans that they know they're going to get back. Now, what does this mean ultimately? Well, if you'd invested $1 in 2004, you would have returned $7.41. Now that trounces the S&P return as well as this BKX bank index as well. Now, if we look at the overall dividends, well, we can see the overall earnings here in dark blue, plus realized gains more than compensates for the dividend that they pay out. So this is a dividend that's well covered by the income that the company is earning, and is one therefore that we can treat with a degree of safety. So what sort of investment returns might we be looking at from Ares Capital today? Turning to fast graphs, we can use their forecasting calculator. Now, assuming that these estimates of future earnings are correct, and of course that the prices recover to this normalized price to earnings multiple of about just over 10, we could be talking about a total rate of return till the end of 2024 of about 37%, or a total annualized return of 17%. Now that includes a nice dividend yield there of over 10%. Now, pick number 2, Capital Southwest. Now, this is another BDC, which basically does the same thing as Ares Capital, but with a slightly different approach. Now, the company does have a long history, but most of this is also coloured by a recent spin-off. Their performance since that spin-off has been exemplary, with very strong dividend raises that we'll look at next. So look, over the last 4 years since the spin-off, they have been doing beautifully. Now you'll see here in blue there's a beautiful regular dividend payment going out here. It is strong, it is growing. On top of this, they've also been paying some supplemental dividends per share, as well as the occasional special dividend per share. Now, the way that they've approached this regular dividend is one that is safe, that you can bank on, and then when they're doing well, there'll be these additional supplemental or special dividends thrown on top for extra income. Now, one of the really attractive things about Capital Southwest is their very strong focus on first lien on their credit portfolio. So as we can see here, the credit portfolio has been growing very strongly and it is almost entirely comprised of first lien obligations. Now, what does this mean? Well, it means here when you're looking at 2022, what is this, 84% first lien, but on top of that they also have some equity stakes at about 10% as well, which does allow some opportunity for long-term capital appreciation and growth, which is definitely going to be welcome by many investors. Now finally, as we saw with Ares Capital as well, strong diversification here by industry, perhaps more diversified than Ares Capital, and also that strong first lien as well as this equity component here as well, providing us with some security of some long-term opportunities here. Now, Capital Southwest seems to be undervalued. It spent the last year trending down, essentially. Turning to fast graphs, looking at the forecasting calculator, we can see that the analyst estimates for earnings have been growing strongly, reflecting the rising interest rates and the strong credit portfolio here. Now, if all goes well and prices return to these levels and the analysts get those earnings correct and prices return to that historic 14 times price to earnings multiple, by the end of the 2024 year in March, we could be talking about total rate of return of 115% or an annualized rate of return of 85%, and we have a stronger dividend yield than what we saw with Ares Capital of 11.6%. So some quite nice returns there. And now, number one for 2023 has got to be Main Street Capital, operating in the lower middle market. Main Street has a long history. It has a strong history, and it's one that I think we can bank on today, this year. Like the other BDCs we've looked at today, they have a wide diversification here over quite a large number of industries without a huge concentration in one particular industry. Now, this provides us with some security as the economic conditions change. It's not going to adversely affect their portfolio too much because any challenges in one area of their portfolio is going to be offset by gains in another area. So the lower middle market portfolio, 75 companies, debt yielding nearly 12%, which very nicely covers their dividends as well. Most of this is first lien as well. And on top of that, the strong equity position and ownership as well in these companies, which is going to propel and provide capital appreciation as well as dividend income in addition to repayment of debt. So this is Main Street Capital. Now, why do we like it so much? Let's just have a quick look at some of those dividends. Now, this is on Stock Rover, and it's showing us that since 2007, the dividends with reinvestment has increased Main Street Capital's total return to over 400% to today. Now, when we look on the chart here as well, we see not only appreciation of the price here, which we don't often see in BDCs, but we see a very, very, very strong total return here as well because of the reinvestment opportunity of those dividends. Now let's dig into this and let's have a quick look in comparison of these three companies and their dividends. Now going over to the TIKR Terminal, this provides us with the opportunity to visualize some of what's going on here with the dividends. Now, if we look at Ares in green here, we can see that during the global financial crisis, they decreased the dividend payments, and they've been holding them fairly steady and increasing them slightly in more recent years. Capital Southwest in comparison though in purple, since the spin-off 2017 onwards they've been growing their dividend quite strongly with a slightly more muted growth in recent years. Now let's compare that though to Main Street Capital. So adding them back here, we can see that since 2007 they have been growing that dividend, and when we put the others back on there as well, we can see that that growth rate is outpacing Capital Southwest and Ares. Now that is one of the key reasons why I really like Main Street Capital. So what type of returns can we expect from Main Street Capital going forward? Now look, they haven't exactly been on a tear in the last year, but we can see as well strong expected increases in earnings over the next couple of years, buoyed by higher interest rates. Now if we look at the end of the 2024 financial year, we're talking about potentially total returns till then of about 73% or a total annualized return of about 31%. Now, it's got a high dividend yield of 7.3%, which, as you know, is lower than the other two BDCs. But this is a dividend that we anticipate will continue to grow with time strongly and solidly, while also delivering those capital returns that we talked about. So for 2023, Main Street Capital, this is the top pick from me today. Stay tuned, hit the subscribe button, and hit me a comment down below on which of these BDCs you like, or if there's any other BDCs you prefer more than these. Stay tuned, and I'll see you soon.